Okay, so in this video, I'm going to be revealing a really good pre-off horse racing trading strategy that you can start using in the market to really skyrocket your profits. Now, this strategy that I'm going to show you is a back to lay strategy. So we're going to be placing a back bet first and then a lay bet a little bit later on, and therefore netting the profit in between the two. Now, this strategy is also commonly known as backing a steaming runner. So you're going to be able to use this yourself to make some nice profits with it. And what I've done is I've actually broken it all down step by step into 3 different phases so we can walk through it each step of the way, and I'm going to give you a really good feel and a really good understanding of how you can start using this yourself in the market. So if we look at this presentation that I've developed here, this is the kind of thing that we're going to be looking for with this strategy. So you can see this was the starting price on the run. It was about 1.44, and this was the chart to go along with it along the right hand side. Fast forward a few minutes, this was the ending position. You can see the price come down to about 1.32. This was the chart, so it started up here and it finished all the way down here, and you can see this was the profit along the left hand side of this ladder screenshot, which was just about £75. Here's another example, same thing again, runners priced at 4.3 before the move starts. This was the chart, so pretty flat chart. Fast forward a few minutes, this was the chart, so the price come flying down, and I made a profit of around about £100 from backing it up here and laying it down here, and you can see the price went flying down the ladder. And of course, same sort of thing again, price is 3.3, pretty flat chart on the screenshot before the move. Fast forward slightly, the price comes flying down to 262. The chart represents that steaming runner as well as the price comes down. And you can see I made about £45 from trading that one. Okay, so let's dive into this strategy. And like I said, I've broken it down into 3 phases. So I really want to try and give you as much information as I possibly can around this strategy so that you can, fully understand what you're doing and what you're looking for. And the best way I could think about doing that is by breaking it down into 3 individual phases. Okay, so phase number 1 is entry point. So when you're defining an entry point, or when you're deciding where you want to enter on a runner, the first thing I recommend that you do is define the range on any potential candidates you have for any possible steamers. So what you're looking for is a tight and well-defined traded volume range. So to expand on that, if you look at the favourite, which is the ladder on the left-hand side, can you see this traded volume range along the right-hand column of the ladder, of the left ladder? Can you see how that's well-defined? All of the volume, by and large, is traded across just a few individual prices. There's not like 10% of the volume matched up here and 20% of it matched down here, if you know what I mean. It's all traded at or around this price here. Now granted, you get little bits, there's like 0.2 of the traded volume up here and 0.4 of the traded volume up here, but the point I'm trying to make is more or less all the match money on this runner has occurred at these few prices. Now if you look at the second runner, that's not the case. Can you see how that's a longer traded volume range? It's much less well defined than the first runner, which is in a really tight range. Third runner actually meets that criteria. It's in a tight traded volume range again, where the money, backers and layers have only matched across a few different prices, starting at about 8.4 and then coming down to about 7.4. And again, there is a little bit of variance, there is a little bit of money matched above it, but you're looking at those bars and how well defined they are, and you can see on the first 2, very significant here. Not the first 2, the first one and the third one, sorry, and then on the third one, significant traded volume at that specific price. Now, quickly, if we look at the fourth one, criteria isn't there, right? If you look, long, windy traded volume range going all the way up to about 50 and starting at 27, and then on the last one, the fifth one, same thing again. The traded volume range is really long and it's not well defined. So the first thing you're looking for, in a nutshell, is to look for a traded volume range which is well defined on a runner. So that's your criteria for the first part of phase 1. So the next part of phase 1, as you can see here on the screenshot, is the common sense check. Now, this is what I call it. You might want to call it something different, or you might have a different way of understanding what you're doing. But fundamentally, at this point, I'm asking myself logical questions, and I'm not being emotional about what I'm doing. I'm just saying, looking at these two runners that we've defined as possible steamers, can I apply some common sense which will eliminate it down to one runner which is the most likely to get the backing support? So for example, if you look at the favourite, which is a runner on the left hand side, well, pretty much just said it there, that is the favourite, and very often people like to have a bet on the favourite in the last few minutes and things like that when they can see everything's okay with a horse. And to add to that being the favourite, it's a really short price, it's a really heavy odds on favourite. So there's some common sense right there. It's the favourite, it's a short price favourite. Everything else throughout the market, because these are numerical in terms of odds, has no real chance relative to the favourite. At least that's how the market's pricing it. The next point is look at all this money queuing up on the backside above where the best back price is at 1.43. So that's a heavy amount of money. So if someone comes along and places a lay bet of like £400, and then someone else shortly after comes along and places a lay bet of £1,000, so near enough £1,500 goes through the market isn't just going to fly off and you're going to head into a big loss straight away, because there's a lot of money insulating you at that price. So you'll have time to react and slowly think about what you're doing. You don't have to be on eggshells because there's a lot of money holding the price in position. Whereas if you view that on the third favourite, which is the other runner we defined as a possible candidate for this strategy, can you see there's hardly any money sitting at all of these individual prices? There's like 25 quid and 500 quid and 20 quid. So the same thing again, if you applied the same logic again, if someone come along and laid £400 and then someone else come along 2 seconds later and laid £1,000, the price would just be all the way up the ladder because there's no money holding the price at that level. So what you're doing basically is you're applying common sense to your thinking and you're eliminating runners down which you've selected as possible candidates until you find a runner which fits the common sense and is sitting within a tight traded volume range. And you can see that is obviously the favourite in this example. So the next point I want to touch on in phase one of this strategy is looking for supporting signals which confirm your idea and confirm your hypothesis, right? So what I would do is I would look at the best available back price at any one time, which you can see here is 1.43. This is the price at which you can bet immediately, place a back bet immediately and get matched up. And you want to be looking at the traded volume range. So can you see on the traded volume range at odds of 1.43, there's around about 15% of the runner's traded volume matched at that price, 14.9%. Now in BetAngel, you can change that. You can use it as a percentage or as the numerical traded volume amount. So anyway, you're looking at the best available back price at any one time, 143. So this was before, this was a few seconds after, 143. Can you see how that amount of money traded at that best available price is jumping up? It's jumped up almost 1% to 15.8%. And you want to keep seeing signs that the people are still willing to back the runner at the best available price. And by the way, if you want me to walk you through this entire process with the actual video recording of this market, so you can get a nice feel for exactly how you can use this yourself in the market to make as much money from it as possible, after you've finished watching this video, then check out the link in the description. I've put together a quick walkthrough video which will walk you through it each step of the way, and it will get you on track to making as much money as possible from using this strategy. So if you're not seeing that consistent backing at the best available back price, that will tell you that people aren't interested in backing the runner anymore at that price. And the perception, the overarching perception in the market is that the price is too short to back the runner. However, in this example, you can see there's still backing at this price. You're in a tight range, there's still backing at this price, which indicates that people are still willing to put their money on this runner at the best available back price. So when you've done that and you've seen that you're getting consistent backing support at the best price, you've identified the runners in a tight traded volume range, you've applied various common sense checks to eliminate any other runners down, you're almost ready to get involved and place your back bet on the runner and identify a steaming favourite or a steaming runner. But there's one more thing you want to do, and you want to identify where your stop loss is going within the market should things go wrong. Now, what you shouldn't do is you shouldn't get involved with the market and then, let's say, the 2 minute mark comes along shortly after and the price sort of moves against you 2 or 3 ticks in that chaotic period. You shouldn't just immediately panic and freak out and hedge and get rid of your position. And if you do feel like you want to do that, top tip for you, your stake might be a bit too large. because you will get that volatility at moments in the market, like the 2-minute mark, where the price moves around. But what will happen over another short period of time is things will just correct out. This is what I've found anyway. And then the true direction of the run-up will be known to you. So you want to identify a stop loss area, and you want to go outside of the traded volume range, and you want to give it a bit of wiggle room as well. So the top of the traded volume range is about 1.47, isn't it? Give or take. You wouldn't want to go at 148 as a stop loss. You'd want to give it a little bit of wiggle room in case the price just comes out, sneaks out a little bit, and then comes back down. So I would say if the price comes up to 1.5 and starts moving against you, and you can see consistent laying at that point and consistent weakness in terms of your position, slightly above 1.5, I would say call it quits. The price is moving against you and you're probably going to get a drift and you've got this trade wrong. But like I said, you don't want to have it set too tight to where your position is, because you will get a bit of variance. The markets are noisy and they are volatile, and you want to just give yourself that little bit of wiggle room just in case you do get a little bit of variance and a little bit of volatility. Now you'll see in a minute that the upside compared to the downside of 5 or 6 ticks or whatever it is it significantly outweighs the downside, and this is why this strategy works so well. But just to add a little bit more to that point, if you're in a long windy traded volume range, can you see how far you would have to have your stop loss set? Let's say the traded volume range ranged all the way up to like 157. The price could regress up that traded volume range and then come back down again after that. So your stop loss would have to be set all the way up the ladder. So that is one of the big reasons why you're looking for a runner which is in a defined traded volume range, because once it moves one way or the other, that will typically be pretty decisive as that support or that resistance has become broken. Right, so at this point we have a checklist on screen, and this is just outlining what we've done. Defined a runner within a traded volume range which is tight, touched on that. Applied common sense and logical thinking. We're not thinking emotionally, we're breaking things down, we're understanding the logic behind the situation, and we're eliminating runners which aren't fitting that common sense approach after we've defined any runners which are tight within their traded volume range. Now we've looked for supporting signals, i.e. continuous backing at the best available back price at any one time, which shows evidence that although the price potentially is towards the bottom of its short traded volume range, people are still willing to accept that back price and still willing to bet on the runner and place a back bet on the runner, that is. And when you've found all those things, you want to define a stop loss price, or an area in which you're saying to yourself, this trade's gone wrong, this trade's moved against me, and I'm going to hedge my position for a loss before the price crashes away from me. And like I touched on, you want to do that slightly outside of the traded volume range, giving yourself enough wiggle room, and that will allow you to look at the market consistently and see whether the market's just ticked up for a few bit of variance in a few seconds and then the price is going to regress, or if there's actually substance behind the price drifting out, which obviously in our situation would be bad. And the last thing we want to do, which is highlighted in bold here, is open the trade. We've got all our criteria set. It's now time to open our position into the market. So you can see that's exactly what I've done. I've placed a back bet on the runner at 1.43, and I've used £1,000 stake on this runner. And you can see along the left hand side of the screenshot, each time the price moves down, I'll gain round about £7 of profit. Now, if you're not at the stage that I'm at, don't use stakes at this level, because it's going to feel immensely painful with each tick that it goes against you temporarily. So use stakes that you're comfortable with, it goes without saying. And as you get comfortable with this strategy, start increasing the amount of money that you're using, and it will feel gradually more and more natural. But for me, I was happy going with £1,000 stake on this runner at this specific price, and I've got involved with the market at this position. Okay, so moving on to phase 2 of this strategy, and phase 2 of the strategy is confirming the move and confirming that what you've thought about and the decision that you've made is the right decision. So what you'll start seeing, ideally shortly after, is that the price is starting to come down. You can see I'm up to about £14 of profit, almost £21 of profit, as the price is slowly starting to move in the direction and in my favour. And you might start seeing, if you look at your chart, your advanced chart on your ladder screen, you might start seeing support like that and the price slowly starting to move down. So it was in this tight, well-defined area represented about here, and you can see it slowly started to move down. So then, once again, confirming the move, you want to be looking at the same sort of signals you were looking at when you were defining and looking for signals to get involved with the market in the first place rather. So each of these screenshots are about 2 or 3 seconds apart. And you can see you want to be looking at the best available back price at any one time. 1.4, you can see there's about 2.7% of the runner's traded volume which is matched at that price. Fast forward 2 seconds, you can see there's now 2.8% matched at 1.4. And can you see below those prices which hadn't got any money matched a little bit earlier on, there's no money matched there, which indicates people are chasing the price down and they're chasing that move and that steam on that runner. So look at 1.35, which is the next available back price. Can you see there's no volume match there? There's nothing within that column, within the traded volume range. Jump forward a few seconds, and can you see there's now 0.5% of the runner's traded volume range, which is now matched at that price, which is indicating that people are still backing that runner. So you're looking for those supporting signals, you're looking for the price to start moving in your favour and not continually moving against you, and people to continually be backing with each new available back price that comes along as the price gets shorter and shorter and shorter. And by the way, we just take a quick time out. I just wanted to let you know that my training program is linked down below in the video description. This is a premium training program, and if you're looking for somebody to walk you through a strategy in great detail and then go through that strategy with various live examples, then this training program is something that you've been looking for. I've had a lot of positive feedback and a lot of success stories from people that were struggling in the market, not really knowing what they were doing, I think it's fair to say, and I've helped them start making consistent profits with their trading. So if this is something that you're looking for and you're looking to stop losing month after month, then check out the link which is down below in the video description. So at this point, when you're in phase 2 and you're confirming the move, your chart, your advanced chart, will likely start to look something like this. So you can see it was static for quite a long period of time. That's when we got involved. That was where the tight traded volume range was. We started seeing pretty significant signals that the price was ready to crash down, and that's represented by this part of the chart. And then at one point or another, you'll probably get something like this, where you get a humongous spike as the price starts to crash down and as people start to freak out and panic and fear and emotion starts to grab hold of the market. So with that being said, we then move on to the third and final phase of this strategy. So far we've defined where the entry point is, we've spotted and determined that we were right and the market is moving in that direction and it's moving in our favour. The third part of this strategy, as you can see there, is finding the bottom of the move or hedging your position. So it's no good getting involved with the market and the price starts moving in your favour and then you cash out almost immediately, but the price had another 10 or 15 ticks to steam down and you've cut yourself short effectively. And on the flip side of that, it's no good watching the price come down for ages and ages and ages and then the price gets too short and starts moving back and then you drain your profits which you could have had at the bottom of the range that way. So phase 3 is all about spotting the bottom or more or less the bottom of the move and hedging and taking out your profit from the market. So if you look at this screenshot, this was round about the bottom of the move. So it started up here at about 143 and it moved down to just above 1.3 and that's a nice move in price. And this was the chart when I hedged my position. So it started up here in this tight, well-defined range as we touched on. We got the support, we got them confirming signals indicating to us that we had the right move. And then this right here was round about the bottom of the move. So how did I know to hedge my position at this point and take my profit? Well, that comes down to a measure of volatility. So if you look at the image on the left-hand side, this image represents higher volatility in the market, whereas the image which is on the right, of course, that represents lower volatility. So what you're looking for is the volatility to become decreased. So you're looking for the volatility to increase as the price comes crashing down and the market becomes chaotic and volatile. And then when the market decreases in volatility and people refuse to back anymore and hedging starts up and that lower volatility point has become reached, that's the point where the market is likely to start rebounding and going back up. So you can see when this big spike come in with the price, which is obviously the red line on this chart image, those bands above the red line, which represents price, become larger. So you can see how they were tight together initially, this band here and this band there. That was when the runner was in a tight traded volume range. And as the price starts moving down, that range between the top price envelope and the bottom price envelope starts to increase. And then when fear and panic starts taking over the market and people start freaking out, chasing the price around, all trying to get their back bets on and all jumping all over each other. You get this with the price and the volatility measured by the price envelopes on the top and the bottom. That represents high volatility. You won't want to hedge your position at that point because the market is in high volatility mode and people are jumping all over each other, pushing the market in a specific direction. Now if we move on to the right image on the right hand side, this is where the volatility is decreased. So you can see it's high volatility here, represented by these dotted lines. It gets down to this point, and that volatility, defined by those price envelopes, decreases and becomes tighter. And as the runner starts getting stuck within a traded volume range, the volatility decreases. This is around about the point where you would hedge your position. So you can see that's what I did in this screenshot here. You can see the price comes crashing down. It's getting stuck in a range, which is this range here. It's getting stuck there, and those price envelopes are becoming tight to each other, represented by those dotted lines. That's around about the point where the market is done and stalled, and that freaking out period of the runner steaming down seems to have come to a close. And you can see the chart at post time is this right here, and this is exactly what you're looking for. The runner stuck in a tight traded volume range at the bottom of its range after the steam, and that's represented by obviously the red line, and it's stuck at that price with each second that goes by. Those bands getting tighter and tighter and tighter, and given a few more seconds, they would have become super tight to each other. That's the point that you're looking for. So you can see, I back the runner looking for a steam at odds of 1.43 for £1,000. You can see that there on my match bets, 1.43. And then a little bit later on, I laid the runner at odds of 1.33 for £1,075, which is round about here. So I was just slightly ahead of the market, which comes from experience. And then this point here was probably the true point where the market had stalled and the volatility had decreased down to a point where you would hedge. So even if you back the runner at 1.43 and the volatility decreased to this level, you would have still laid at 1.35 and you still would have had a nice profit. So if you want me to break down this strategy with the actual videos and the actual recordings of the market and break it down for you each step of the way, then check out the link which I've got down below in the video description. I've put together a quick free course which will explain that in nice detail to you. And on top of that, I'll also tell you how you can go about creating this advanced chart so you can get these price envelopes and you know where to get involved and where to exit the market when that volatility decreases after that steam. So I'll show you how to create that, and I'll walk you through the video example which explains how you can spot this steaming runner in this setup. So yeah, thank you very much for watching this video. If you want to see a similar type of trading strategy in action, then check out this right here. It's just coming up on screen, and that will show you a really simple hack you can use on the favourite when the previous race has only just finished. It's really good. A lot of people don't know about it, and it will increase your profits. Thanks for watching. I appreciate your time, and I'll see you again in the next video.